Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to a new episode on investment. So this is just a quick guide on how to invest. So it's just a beginner's guide on how to invest, really. So in the first point, we're going to look at what is investment, why you need to invest. You have to know all of that. You have to do your own research, your own homework, since you didn't do your homework or you are more fascinated about investment. So I'm going to do the homework for you and give you a quick start up, really. We look at what is investment, why investing, or why do you need to invest. You need to have a goal inside the mind, a vision as well. And I'll give you a note before investing, so the things which you need to know to understand before you get yourself into investment. So it is not like you have to taste the water with one foot, of putting all your eggs in one basket or putting all your feet in the water. So you have to test the water first. That's like doing your own research, doing the homework as well. So the first point we're going to look at understand why you want to invest. You have to understand that. That's a crucial point. The second one would be just the basics, different investment types. So we look at different investment types, which one are good, which one are bad for beginners, which one for advanced ones. So we try to differentiate them with practical examples as well. The third point would be like to determine your risk tolerance, your pain points. How much can you tolerate? Or how much can you invest? How much can you bear to lose? So in the case of investment, it's not too far from gambling, really. So you have to be ready to lose money as well. It's not all about gain. There's gain and loss. So that's what you have to understand. The fourth point would be to build that diversified portfolio. Then the fifth point it will be on the start with low cost index funds. That's the crucial point. You have to start with low cost index funds as well. The sixth point we look at understand the power of compound interest. The compound interest is crucial as well when it comes to investment. The seventh point we're going to look at the set up automatic contributions. In the case like payments, you can set automatic contributions. Like in the bank, you can set that on the online banking. Number 8, avoid common mistakes. So we're going to touch on the common mistakes as well, which many people usually start complaining, really, or people start regretting in the future. So in this case, since you're still the beginner, since you're watching this video, I'm going to tell you which common mistakes to avoid as well. So it doesn't matter if you're still young or youth or in old age, it doesn't matter. It is all about investment for beginners. As long as you're a beginner or advanced or medium, I think this video is going to be useful for you. So the ninth point will be on the regularly review and rebalance your portfolio. Like you have to keep reviewing you have to keep regular review as well, and try to rebalance your portfolio. Really, trying to go back to the origin state where you started, not to get too much excited. Really. Number 10, we're going to look at the start small. Like learn as you go. You start small first, and then you learn as you go. You keep increasing your knowledge. So the more you learn, the more you understand which ones are good for you and which one must be avoided. Then after that, I'm going to give just a quick summary as I usually do in all the episodes, just to sum up really what we learned in each video. So are you ready, ladies and gentlemen? Tighten your belt and let's begin. So beginner's guide to investing with practical examples. Video brought to you by Mwanandeke, Kindembo. So investing can be a powerful way to build wealth over time, but it can feel intimidating at the same time. It's a good way to build wealth, but it can be intimidating as well without knowledge, without knowing where to start, where to begin. So if you are just starting out, it can feel intimidating. So this is a beginner's guide to help you understand the basics. It's all about the basics. So if you are more into advanced, really, you already know what to do, I think you can move on. So what is investing? So what do I mean by investing? What is investing? When you say you want to invest, what does it mean? So investing is the act of putting money into assets like stocks, bonds, real estates, or mutual funds with the expectation that your money will grow over time. So that's what we're expecting, really. So you want the profit, you want the revenue to come out of your investment. So put small money, then it grows over time. So that's like the expectation of your mind to grow in the near future. It's not all about focusing the present, in the future as well, in the long term. So why invest? Because like investing helps you grow your wealth. So that can be the first reason. It helps you to grow your wealth. like beat inflation. So what is inflation? It's just the rate of increase in price over a given time. That's the inflation, the rate of increase of price over a given time, over a period of time. And achieve financial goals like buying a home, retiring comfortably, like retiring early or comfortably, or funding your child's education as well. You can have, those are like the three reasons, like to build wealth, retire early, and maybe try to fund your child's his education as well. So note before investing. This is a note before you go into investing. This is a note which you have to keep crucial, really, which a crucial note which you have to keep in, you have to hold really to understand. So it is crucial to have an emergency fund within 3 to 6 months is worth of living expenses saved in a liquid. So it is what you need to have 3 to 6 months worth of living before you get yourself into investment. Living expenses saved in a liquid. So what is liquid? It's all about like liquidity is something like easily accessible account. Like in the case of emergency, you might have like emergency savings account or the cash. Just as I explained in the latest video about the terms like the river banks and the financial banks. So liquidity is just like an emergency account or any cash which you have. In the case of emergency, when you need the money, then you get it whenever you need it. So this ensures you are financially stable before committing money to investments. So you have to understand that you have to be, first of all, you need to be financially stable before committing your money to investments. So this is why I said investment is not any far from gambling. So you cannot just gain every time. There's gain and loss or loss every time. So it depends. In the case of investment, you have some security as well. First point we're going to look at understand why you want to invest. You have to understand it. That's the crucial point, number one. So you have goal setting. You have to set the goals as well. So the first step in investing is defining your financial goals. You have to define your financial goals. What do you want to get out of investment? Not are you just doing for fun because someone else did it or because of the hearsay, or you are ready for the investment journey. So these are some crucial questions you have to ask yourself. You have to access yourself really questionnaires. Like, are you saving for retirement? Why are you investing? Are you saving for retirement? A home, maybe to buy a home, a house, education, or just trying to grow wealth really? Those are like the questions which you have to try to answer before you get yourself into investment. The example, like a quick example, like if you are 30 years old and you want to retire at 60, so you have 30 years left to build your like your retirement fund. So if you are 30, you want to retire at 60, you have like 30 years left to build your retirement fund. Like knowing this helps you decide how much to invest and what types of investments to choose. So you have already set your goal. You understand this, it has to be tailored to each individual. Maybe someone started early at 20 or 25. So in your case, maybe you are 30 years. So you want to retire at 60 or 65 or 66. So if you decide at 60, you have like 30 years left. So you have to try to build your retirement fund in that time span of 30 years. So by knowing this, it will help you to decide like what type of investment you have to choose and how you're going to invest as well. The second point, we're going to look at the basics, just different investment types. You have to understand different investment types. So the common ones, people just know about investing in properties and things like that, just buying a house and renting the house. Those are like the common ones, the stocks and properties. Those are just the common types of investment with the majority of people acquainted with. So different types of investment, like investment types. So in this case, the first one we have like stocks, the basics one, or the ones which you already know, the stocks. So buying shares of a company gives you partial ownership. Stocks can offer high returns, but come with a higher risk as well. So it offers high returns, but it comes with a higher risk at the same time. So partial ownership is simply a position in which you can stand to gain when the company performs well. That's the partial ownership. So if you are an employee, you buy stocks in your own company, so you have some type of partial ownership. So whenever the company is doing good, you're going to gain as well as the company keeps performing well. So if the company keeps performing well, then you earn as well as a stock buyer, the stock owner in your company or any company. It doesn't have to be own company only. So the example, if you buy 10 shares of a company at 50 euro, because I live in Europe, I'm going to use euro, not dollar, pound. So if you buy 10 shares of a stock at 50 euro per each share, and the price increases to 75 euro per share, so your investment grows from 500 to be like 50 by 10 to be 500 each. So if the price increases at 75 euros, so your investment grows from 500 euros to 750 euros. So I've already like a benefit or profited there already. Bonds. So what is bonds? So when you buy a bond, you are lending money to a company or government. So in this case, the central banks also usually buy bonds. The central banks are the ones also who print money. Since they are the ones who print money, that cannot buy stocks, they usually focus more on bonds. They usually sell bonds as well to different banks. Then they get like the money. That's how the money keeps circulating over and over. So bonds are generally safer than stocks, but offer lower returns. So in this case, if you want higher returns, you have to stick with stocks, which is higher risk as well. So if you want lower returns with lower risk, then you come with the bonds. You simply own bonds or buy bonds. But it goes slow, the return is too low. So the example, if you buy 1,000 bond with a 5% interest rate, you'll earn 50 euro a year until the bond matures. So it will be like 50 euro a year until the bond matures or increases. Or if there are more bonds, maybe then the return like will be higher than the previous, like, because this 1,000 bonds at 5% interest rate. So the interest rate is like the mechanism really which they use to control the increase or decrease of the price really, or the return. So we have mutual funds as well. So this pool money from many investors, like to buy the diversified portfolio of stocks, bonds, and other assets. Those are like the mutual funds. Just the pool of money from many investors to buy the certified portfolio of stocks, bonds, or other assets. So portfolio is just like a combination of financial investments really, which are like stocks, bonds, and things like that, and commodity as well. So the example, it would be like investing 1,000 euro in a mutual fund might spread your money across 100 different companies. So you invest 1,000, to spread or decertify your money on 100 different companies. So in this case, you're simply reducing the risk compared to buying individual stocks. The mutual funds as well might be a good option for the people who are too cautious, who are not too adventurous. So if you don't want to lose your money, maybe mutual funds might be a good option for you as well. So instead of just betting on one company, so it's simply bet on 100 more companies. If this one fails, then you might get out of 100, there will be a high probability or a high correlation of getting your money back somehow, of 10% or 90% back. They get your return back, your income back. So we have the exchange traded funds, the ETF. You're going to hear that much in this episode. The ETF, just the exchange traded funds. Those are similar to mutual funds as well, but trade on stock exchanges like individual stocks. The only difference is that they traded like on stock exchanges like individual stocks. So the example of that, the practical example, it would be like if you invest in an S&P 500 ETF, you're buying a small piece of each company in the S&P 500, giving you a broad market exposure. So that's the difference of the exchange traded funds with the mutual funds. So in this case, we have another type, which is like the real estate. We're still on the different investment types. So in this case, now we're coming to the one which the real estate as well. So it's all like buying property to rent out or sell later for profit. Those are like the real estate really. Just buying an asset. So investment is all about investing in assets, not liabilities. So the real estate is like you might buy a company, a property really, so it's simply like to rent out or to sell really in the near future, or to sell later for profit. So the example, if you buy a rental property, like let's say for 200,000 euros and earns 1,500 euros a month in rent, that is your income from investment. So the 1,500 a month, that will be like your income from your investment. So start getting some income flow as well every month or every week in the case of rental property. Then number 3 is like to determine your risk tolerance. So we are all different. All the individuals are different. Some people are too impulsive, some people are patient, some people are adventurous, some people are too cautious. So this is like your risk tolerance. You have to understand your own weaknesses, your own strength. How much can you tolerate? How much can you go? So this is like assessing risk as well. So understand how much risk you are willing to take. How much are you willing to take? The pain points. So if you're young with a long time or like a horizon, so you can take more risk. Let's say like investing in stocks. So if you're still younger, you don't have much to lose, and you still have a long time horizon, like you can take risk, like you can invest in stocks. But if you are nearly like retirement, you might prefer safer investments like bonds. So in the case of bonds, we say the return are too low, they come like slow. But in the case of stocks, the returns are high, but the risk also are so high, more risk. The high return with high risk as well. So there's like the high return is directly proportional to the high risk. That's all about investment in the case of stocks and bonds. So you have to weigh it between the risk and the reward as well. So the risk and reward, those are like the key terms in the case of investment. You have to take risk, and there's also a reward. So testing your feet, putting all your feet in the water, or trying to put all your eggs in one basket. It's all about taking risk, being adventurous as well. So risk versus reward is like high risk investments like stocks offer the potential for higher returns, but can also lead to losses, just as we said. So lower risk investments like bonds, which is a lower risk investments, offer more stability but with lower returns. Let's say, for example, like a 25-year-old investor might choose a portfolio that is like 80% stocks and 20% bonds. So try to break them down. Instead of saying 100% bonds, investment in bonds or stocks, you try to break them down, 80% stocks and 20% on the bonds. So even though there is a high risk in the stocks, you still have some the 20% in the bonds as well. So you have some backup as well. That would be the good term to use. Backup is the right term to use. While a 55-year-old might choose 60% bonds and 40% stocks. So in the case of 55-year-old, he's trying to balance 50-50. But in this case, it's like 60% on the bonds and then 40% or 60% on the bonds and then 40% on stocks. So they would want to take higher risk, really. Number 4, we're going to look at the diversified portfolio. Portfolio is just like a collection of financial investments. And financial investments is just like stocks, bonds, commodities, and things like that. So desertification or diversification is like don't put all your eggs in one basket. The famous saying, the famous axioms, don't put all your eggs in one basket. So spread your investments across different assets classes like stocks, bonds, real estate, and sectors, and different sectors, like we can say in the sector of technologies, healthcare, etc., like to reduce risks. So try to look at different asset classes and different sectors, not just in technology. You can go in healthcare as well. So example, like instead of putting all your money into one tech stock, you might invest in a mixture of tech, healthcare, and consumer goods stocks, along with some bonds and real estate as well. That's how you try to balance them out instead of putting your eggs in one basket, because it is like a gambling. So you cannot gamble your life in something like that. You have to be smart as well as a fox. So try to break them down. Really, you invest in a mix of tech, healthcare, and consumer goods stocks, along with some bonds and real estate as well. Instead of just stocks, you focus on the bonds and real estate as well. So the 5th point we're going to look at is start with low-cost index funds. Starting low as well. Not trying to jump because your friend is already here, you want to jump here as well, or above them. Not try to imitate someone. You have to look in your pocket as well. How much do you have in your account? How much can you tolerate to lose? So you have to start with a lower cost index funds as well. So why index funds? So for beginners like you and myself, so for beginners, because we are still beginners, so low cost index funds, or the EFTS, exchange trade funds, are a great way to get you started, or to get started. So they track a market index like the S&P 500, which you mentioned earlier, and provide instant diversification at a lower cost. So the example, if you invest, let's say, 1,000 euros in an S&P 500 index fund with an expense ratio of 0.03%, so you are paying only like 0.30, like 30 cent euro, 0.30 euros, something like that per year in fees. That would be like the fees which you will be paying really if you invest in an S&P 500 index fund. Then number 6, we're going to look at understand the power of compound interest. The compound interest as well is crucial. It's all about interest, trying to make the money out of interest. So the interest also making money, producing money, or bringing income. So that's about number 6. Really, you try to understand the power of compound interest. In this case, you have to read more books and articles as well. So there are many great resources available to help you to learn more about investing. So you have to try to get yourself acquainted with different sources on the resources, really, learning books, different articles to help you learn more about investing. It's all about knowledge, really, getting more knowledge before you put all your feet in the water. So consider books like the Little Book of Common Sense Investing by John C. Bogle, or the Intelligent Investor by Benjamin Graham. So you can follow like financial news as well. So keep yourself updated. In the case of investment, you have to keep yourself updated. If you don't like reading, this is the time to start cultivating that skill. You have to keep reading the news all the time. In the case of a recession, in the case of inflation, in the case of that, so keep yourself well informed. So and they like follow financial news as well. So you stay informed about the economy, the market trends, and the changes that may affect your investments. So you have to be changeable. Like in the case of investments, it is like the wind, it cannot be predicted. So you don't know which direction it's going to flow next. The only solution is to keep yourself well informed, updated about the economy, the market trends, and the changes that may affect your investments. So in this case, in compounding or the compound interest, this is when your investment earns interest, and then you earn interest on your interest. This is like interest brings more interest, endless interest. So you try to play the game which they are playing as well, like the banks. So over time, compounding can significantly boost your return as well. So compounding interest is good once you understand it. It can significantly boost your returns. So the example, so if you invest 1,000 euros at, let's say, at 7% annual return, so after 30 years, it grows to 7,612 euros. So if you add 100 euro a month to that number, it grows to 122,760 euros. So it's saying 30 years because you're expecting that you are 30 years and you want to retire at 60, something like that. Then number 7, we're going to look at the set of automatic contributions as well. So in the case, contributions like trying to set up automatic payments or contributions, investments. So automation as well. So to stay consistent, set up automatic transfers from your bank account to your investment account. So you can set that like online banking, or can go to your bank and try to set like automatic contributions. So example, if you set up an automatic monthly transfer of 200 euros to your investment account, you are constantly investing without having to think about it. So in this case, it is good if you've got some capital or some money in your bank, so you don't have to think about it. It just goes automatically to your investment account. But for some people still worried, 200 euros, I think that would be too much, or $200, that would be too much. $200 plus, that would be too much every month. So you can start low as well, just as we mentioned above. So number 8, you've got to look at the avoid common mistakes. The common mistakes which you have to avoid for beginners. So it's like trying to build good foundations. When you lack the good foundations, even though you call yourself expert, when you lack the foundation, it's still useless. Maybe in the common mistakes as well, maybe you can learn here, even though you think you are more advanced in the investment, really. So there are common mistakes which you have to avoid, like avoid frequent trading, like frequent tradings, or like sales, trading, like transactions. Frequent tradings, like buying and selling. So buying and selling investment frequently can incur like transaction fees and taxes, so reducing your overall returns. So you have to try to avoid selling and buying, just to keep your transaction fees good and taxes as well. You have to avoid emotional investments. So in this case, it is not about emotions. So in the case of investment, you need to have good foundations. The wind is so strong here, maybe the storm will come and take you, the erosion or things like that. It is the game which is cannot be predicted. It is unpredictable. So it cannot be emotional. You have to be more logical. Leave emotions to women. They say women are more emotional, men are focused more on the reason, more reasonable. So you have to avoid emotional investment, like investing. So avoid making investment decisions based on emotions. Rather focus on a reason in this case. So market fluctuations are normal. So stay calm during market downturns. So you have to stay calm as well. Maybe meditate, things like that. Daily meditation might be good, or keep planning, keep yourself updated. So there will not be any surprises really. So if there's a big surprise, you might have a heart attack, like the market crash in 2008. Many people go heart attack, suicide, and things like that. Those are the common mistakes which you have to avoid, because this is about money. Heart attack is also involved emotions. So the example, if your stock market drops like 10%, there's a big figure, 10%, like avoid panic selling as well. So if there's a big drop, that does not mean you have to start selling all your stocks or your bonds. You have to avoid panic selling. So you have to avoid panic selling. Like historically, markets tend to cover over time. So you need to have hope. So the point to take here, like the key takeouts, is like you have to avoid panic selling, buying and selling, in the case of a drop or increase. So we're going to look at we're still under number 8, the common mistakes which you have to avoid. Another one is like the high fees. So understand expense ratios. So watch out the investment products with higher fees, so which can eat into returns. So you have to watch them out, investment products with high fees. So the example of that would be like choosing a mutual funds with a 1.5% expense ratio means like paying 15 euros per year for every 1,000 euros invested. So if you're choosing like a mutual fund of 1.5%, expense ratio means like you're going to pay 15 euros per year for every 1,000 euros invested. Like compare that to a 0.03% index fund, which we did earlier, where you pay just 0.30 euro or 30 cent, 0.30 euro. So number 9, we're going to look at the regular review and rebalance your portfolio. Portfolio is just a collection of financial investments. So you have to keep reviewing them really and trying to rebalance your portfolio. So in the case of rebalancing, like over time, some of investments will grow faster than others. So in the case if you divide 100 assets or 100 departments, some of them will grow faster than others. So shifting your portfolio is balance. To shift your portfolio is balance. So rebalancing brings it back in line with your target allocation. So you need to have the target allocation. So you can understand when there's a rebalance, when it goes higher or decreases, or when it is in the balance, or when it is with your target allocation. So the example, so if your portfolio was originally, let's say 70% stocks and 30% bonds, and now it is like 80% stocks due to market gains, you might sell some stocks and buy more bonds to return to your original allocation. So there's like a misallocation already. So you start with 7% stocks and 30% bonds. Now you end up with the 80% stocks due to market margins or market gains. So you might sell some of them and you might sell some stocks and try to balance between stocks and bonds as well, and buy more bonds to return your original location or allocation. Number 10, we're going to look at the start small. This is a good advice for beginners. You have to start small, learn as you go. So learn as you go along by starting small. So start investing with what you can afford. Start by investing with what you can afford to lose. So it's like gambling, as we said. Start with what you can afford to lose. That's all about investment. So even small amounts can grow significantly over time thanks to compound interest. So compound interest is like you have interest, getting money out of interest, interest over interest. It's like the loop, continuous loop. So the compound interest is like interest accumulated from from a principal sum and previously accumulated interest. Just interest accumulated, which adds up from a principal sum and previously accumulated interest. So you don't need a lot of money to start investing. There's the things which you have to take out of here. You don't need a lot of money to start investing. Many platforms allow you to start with as small or as little as €10 or €50. So you just have to know which platform to go to. In this case, I can show a little example. Even the banks, bank really, you can invest maybe at 10% every month, something like that. So practical example, like a simple portfolio. So we said a portfolio is just a collection of financial investments like stocks, bonds, commodities, etc. So let's say the 80-20% rule. So the 80-20% rule. So let's say you're 30 years old and you want to start with €1,000. That is what you have. 30 years old, you want to start with €1,000. The €1,000 like the money or the capital which you have allocated for your investment. So you might allocate, let's say, 80%, which would be like €800. 80% of 1,000 would be like €800 to a stock index fund, like an S&P 500 ETF, and 20%, like which is €200, to a bond ETF. So this gives you exposure to the stock market for growth and some bonds for stability. So people usually go for bonds in the case of stability. The people are too cautious. But for young people, because they're too adventurous, too daring, you can go for stocks instead. So in the case of automatic contributions as well, you can set up an automatic transfer of €100, let's say, per month into this portfolio. So you set like an automatic contribution, like in the case of the bank, you just transfer that into your investment account. So review annually, like you keep reviewing annually. So at the end of each year, like you check your allocation. So if the stock market had a greater year and the stocks now make up like 80% of your portfolio, you have to sell some stocks and buy bonds to return to 80-20 target. This is a crucial point as well to take out. So if you go higher, like 80% of stocks, you have to try to sell some stocks and try to balance between the stocks and bonds. Try to go like to your original target, which is 80-20 rule. So what can you say in summary with about the stocks, the bonds, the commodities, the rental, the properties, the assets? So stocks is like assets really, buying and selling. It's all about knowing when to buy, when to sell, when is the interest rate lower, when is it higher, and things like that. So in summary, what can you say about investing as a beginner? So investing does not have to be complicated. Most of the people usually make it more complicated as it looks. As you heard now, like as you're following with me. So investing is a powerful tool for building wealth. I think you can agree with me on that. So, but it requires education, is patience as well, and a long-term perspective. It's not only about short-term. You have to think in the long term, in the future, like education for your child, supporting education for your child. Those are like the long-term goals. In the case if you get married, you have to think about your family, maybe retiring to like 60 or 65. So you want to break the rule of trying to retire at 65 or 67. Maybe you can try to retire 50, 55 or 60. So start by setting clear goals, understanding your risk tolerance, your weaknesses, your strength, and choosing the right investment accounts and assets. That is where you have to start on. So with time, consistency, and carefully planning, your investments can help you to achieve financial security and grow your wealth. So when you have all of those things really, when you carefully plan everything out, and with time as well and consistency, like keeping reputation without getting tired, your investment will actually help you achieve your financial security. Does everyone want financial security in the future or now in the present, and grow your wealth as well? So ladies and gentlemen, just as we began, thank you so much for listening. Don't forget to like, comment, share the video, and keep commenting your suggestions, really opinions, or the next video you want to see next. So thank you for listening, and thank you for your patience. Ciao, bye.